So we're gonna talk about warranties in this video. Uh, so as we know, a lot of companies sell products, they provide warranty on them. And we also know that whenever we sell a product that has a warranty, if there will be any damage in that part, the customer is not gonna come back the same day he purchased it most of the time. It's probably gonna be after a month or two or maybe a year, okay? And then going back to one of the accounting principles, which is the matching principle, it means matching the expenses and the revenues that incurred in the same year, record them all the same year as well. Any revenue for selling these parts or selling that inventory to customers, if there will be any costs associated with that revenue from selling them, we need that to be recorded the same year. Well, what if I sold these parts in 2017 and the customer comes back in 2018 asking for a warranty coverage? How can we record that expense of covering fixing that part? How can we record that expense in 2017 if the customer is coming back in 2018? There will be no matching there. So the matching principle is not going to work if we're going to wait for the customer to come back next year. So that's why we're going to make an estimate in 2017. So by the end of 2017, we're going to calculate what we think the estimated warranty costs that will incur in the future that are related to the sales we did this year. Okay, we estimate that amount and we record a journal entry to debit warranty expense with that amount that we calculated. And then the credit, it's not going to be cash, it's not going to be any spare parts because we're not paying that now, we're not using these spare parts now. It's probably going to be next year. So we will have a liability account in the credit side. We're going to create a liability to have that amount sitting there until next year or the year after, when the customer comes back for coverage, for warranty coverage. Then we're going to use that balance that is inside that liability account to use it for covering these expenses in future for warranty. So here's an example. Assume that PDX company made sales on account of $50,000 costing $35,000 subject to warranties. Okay, $50,000 of parts or inventory, which is subject to warranty. That sale happened on June 10th, and we estimated a warranty to be 30% of sales, 3% of sales, 3% of the 50,000. Okay, not the 35. 35 is the cost. 50,000, 3% of that. So the journal entry to record the transaction. Okay, first of all, we have to record the sales. Well, that's something we know from chapter 2, I think. We're going to debit either accounts receivable or maybe cash. It depends how you sold it. And credit sales revenue, 50,000, 50,000. And then don't forget the cost of goods sold. That's also something that we know. Debit cost of goods sold, credit the merchandise inventory for 35. Okay, those two journals are not what we're trying to learn here because we know them. That third journal entry is what we need to discuss. So on June 10th, warranty expense, although we did not have the warranty expense yet, it's going to happen next year, but because of the matching principle, we're not going to wait for next year. We're going to make an estimate today what we think approximately it will cost us in the future. It's what 3% of the 50,000 multiply, then we get $1,500. So that would be the expense recorded in your journal on June 10th. So it will reflect in the same year you sold these items to customers. And then you credit a liability account. It's called warranty payable. Sometimes they call it estimated warranty payable. At the end of the day, you gotta say warranty payable, okay? That amount of $1,500 in the warranty payable, it will stay there, and then in future, whenever we had those customers coming back asking for warranty coverage, we're gonna use this balance of $1,500 to cover these costs. Okay. So that was on June 10th, and then let's say in future June 27, or maybe the next year, or it doesn't really matter. It might happen the same year where the customer will come back asking for warranty coverage, or it might be next year or anytime. It doesn't really matter because we already secured recording the warranty expense. So assume that some of the PDX customers made claims that that must be honored through the warranty offered by the company. The warranty costs total $800 and are made on June 27. Let's say they were all parts. So we're gonna credit merchandise inventory, which is basically the parts, $800, and then the debit, it's not warranty expense anymore because that has been recorded previously. You're not gonna duplicate that. Instead, we're gonna use the balance of some of the balance we had in a $1,500. We're gonna use $800 of that to cover the parts that we use to fix this item, or whatever warranty we're doing on it. Okay, so we debited the warranty payable. It means I'm decreasing it. So here's the T account for the warranty, for the estimated warranty. Payable account. We credited $1,500 previously. It used to be $1,500 here before covering any warranty coverages. Now that we used $800 of that, we debited $800, so my leftover balance in that payable is $700 that we're going to use in future warranty coverages for future customers that are within the same, for the sales that happened within the same period, the same month of June. Okay, those are the warranty. That's why it's considered a current liability, because of creating that payable account. That's why it's a current liability example.